Hey, how's it going, guys? So in today's video, I wanted to take a look at how the presidential elections have historically affected the stock market in the past. So this has been a topic on a lot of people's minds recently. How is the upcoming election in 2020, an already really crazy year, going to affect the market? So there's already a lot of uncertainty in the market with the virus and the economy. Then we're also throwing on top of this a presidential election. So what I wanted to do is take a look at how the market has been affected by elections in the past and how it's performed moving forward from those dates. So this analysis is intended to be completely non-political. It's just looking at previous history in the S&P 500 based on how it's performed after and before previous election cycles. So before we get into all that, make sure you check out my referral links in the description below. There's $30 off of a pro subscription to TradingView, which is a fantastic charting software. Gives you trade alerts that you can customize and set up for whatever you're looking for. $10 in free crypto from BlockFi, which is a platform that allows you to accumulate interest on your crypto while it's just being held. And then also 2 free stocks from WEBULL. This is another one that you've probably seen before, but it's still a fantastic offer. You can basically just sign up for a WEBULL account, deposit $100. They'll give you 2 free stocks, and you can do with whatever you want with them. You can sell them and just pocket the money and move on from there, or you continue to use WEBULL, which is a much better alternative to a Robinhood account. So I'm going to use 2-year time periods primarily. We'll look at some 1-year time periods as well. But we're going to use a 2-year time period where we're going from 365 days before the election and then 365 days after the election. And we'll call that 2-year time period, an election year time period. And then we'll also have the time periods where we don't have an election year, and we'll call those the non-election year time periods. So this is all the different election or non-election years. And what you can see is that the returns on average were 10.5% for 2-year returns. And there was this sort of time period right around the election, which is right here at this 0. And then you can also see that there's a little dip down during the time of the election. So my first suspicion was that this sort of muted return period right before the election was because of the upcoming election. But actually, if we plot the returns of the election time periods and the non-election time periods, you see that the election year time periods actually don't really underperform. They actually seem to outperform right before the election, and then the election itself causes a little bit of a dip in the performance, but the election years actually outperform the average and the non-election year time period. The next chart that we have breaks down all of the returns for the 2-year time periods of election years by the president that was elected. So in this portion to the left-hand side of the graph, that actually isn't the president that's listed on the right. That's the president before that. And then you have the time period to the right, which is that president. One thing that's interesting about this graph is that you see the years that are negative years tend to be years where there was a downtrend in place even before the election, and the election doesn't really seem to do much to change the trend. So you have these years, W. Bush and Obama's first term with the financial crisis, and a couple of FDR's terms where there was already a pretty significant downtrend in place, and the election doesn't really change that. The other thing that's interesting is that there's a really just wide range of outcomes in all of these different presidents. We'll show you some of the trends based on the party affiliation, but even with that, there's still a lot of variation. So it's hard to say how significant election results are on the outcome of the market. And then you'll see I'll do this on a couple of the other graphs. This is just the 1 year after the election. So just taking out the run up to the election, just looking at what happened afterwards. And the starting points here are the day after the election. So you can see that sometimes there was a pretty significant drop. But again, lots of variation in the outcomes. We're just looking at a year worth of returns, a pretty high amount of variation, but generally positive results. So this graph just expands on the idea that these election years tend to be, outperforming years compared to non-election years. So if we're looking at each of these years of the presidential term, from the first year being the year right after they were elected, to second year, third year, and then fourth year being another election year where they're either coming up for re-election or they're at the end of their term. The highest performing year is the last year of the presidency, and that might make a lot of sense if you think about presidents trying to stay in office and passing a lot of things to keep the economy stimulated. And then you can see in the second and third year, that's when the returns start to kind of take a downturn, right there around the second quarter of the second year. So I think a lot of the concern around elections, comes down to policy changes, right? So when you have a different party coming into office, say from like what we have going into 2020, Republican into potentially a Democratic party, you have implications for the market and for the market participants, like tax rate and other regulatory type of concerns. So I thought it'd be interesting to run a couple different scenarios, kind of in a Bayesian way, where we'll look at what the average returns were running up to the election, and then based on the outcome, if there was a party change, what that did to the returns going forward. So looking at the run-up to the elections, this was one of the things I thought was pretty interesting about all of this analysis, was that when you had a Republican in office, the returns tend to be pretty low and the variation was pretty high, whereas the Democrats, you had a pretty high return in the run-up to the election and then a pretty low variation. So that might speak to the expectations of who's coming into office, right? So if you have a Democrat in office and you're expecting Republicans, you're expecting less regulation, maybe there's a run-up in the market with that expectation. And then the opposite happens when you have the Republican incumbent. So if we play this out going forward from the not knowing who is going to win and just knowing who the incumbent is, to then, knowing who's going to win and then playing out those different averages, we'll see that what I found here was pretty counterintuitive to at least what I had understood about the markets up until at least doing this study. So if we just go through the possible outcomes, so if we start with the existing scenario of 2020 where we have a Republican incumbent, if we are to get a Republican re-election, we play that out, we do get a bump pretty immediately, and then that actually ends up at one of the lowest scenario that we have. If we get a Democrat, we're going to get potentially a drop, or at least the mean is we're getting a drop. None of this is set in stone. Again, there's so much variation, 15% in these results. And then playing out the Democratic scenario, we get the best case scenario being a Democratic to a Democratic election, and then Democratic to Republican. We can see that turns down as well. So then this graph just looks at the one-year returns after the election, showing you how the different parties performed post-election. And one thing I really thought going into this was that the Republicans would have a stronger performance after the election than they did. But I think this speaks to kind of the anticipation of the election. So we actually see the Democrats outperform the Republicans pretty substantially in the year after, at least in the sample size that we're looking at. It really isn't until the recent election of Donald Trump that we see a Republican really outperform the Democrats in that year after the election. So I thought it'd be interesting to look at what type of volatility there's been historically just from the single day move, given the election result. So in general, the election tends to be, I guess you could call it a sell the news type event. It was on average a drop in the market. We saw that when we went back to the first chart that we looked at. There was a little dip in the market, the average election year chart. And then we also saw that the Republican to Democratic outcome was by far the worst outcome, and both of the Democratic outcomes, were a negative result on average, and the only positive result was the Democratic to Republican. So, kind of going with our other findings, where we saw that the Republican tended to give a boost in the 30 to 90 days, and then that kind of waned off, and then the Democratic outcomes were on average, just a little bit higher. So, is any of this information useful? I don't think any of this information is anything you can really trade off of. I think for me, it's important to see just how varied the outcomes are when you're looking at some of these year and 2 year time horizons, and how the election doesn't really seem to play too much of an impact. So nevertheless, I still think it's interesting, information to look at. Especially since we have, one of the more volatile setups, at least looking at the data, where we have a Republican incumbent and, Democratic challenger. So thanks for checking out this video. Please subscribe to the channel if you like this type of material and want to see more of it. Like the video if you like what we showed you here today, and comment if you have any questions or any other things that you'd like to bring up about this topic. Thanks, guys. Have a good one.